Today on In the Money, I'm joined by Drew Skolnik, a partner at KarpReilly, one of the most established names in consumer and retail investing. With over 30 years of experience backing breakout brands like Spindrift, Salt and Straw, Boxycharm, and Cooper's Hawk, KarpReilly has seen every cycle of the consumer landscape, from boom to bust into disciplined growth. In this episode, Drew and I dive into how today's consumer fundraising climate compares to the 2021 frenzy, and why valuations have finally come back to earth. What KarpReilly looks for in brands doing $20 million to $100 million in revenue, and how they balance growth with profitability. The real signals of defensibility, from founder energy to unit economics to authentic community. How trends like GLP-1, protein, and the K-shaped economy are reshaping consumer behavior. And why the best founders today are using AI, influencers, and focus to win smarter, not just bigger. Welcome to In the Money, an exploration of whether you can still make money in D2C and CPG. We talk to some of the most interesting $5 million to $50 million founders, operators, investors, and acquirers in the space to ultimately answer the question, is D2C and CPG still a good business? Hope you'll enjoy the show. Drew, consumer fundraising looks really different today than kind of the boom cycle of 2021. But there has been some recent acquisitions, which I guess downstream have got investors pretty excited. Are we back, and has KarpReilly's bar shifted looking at opportunities today?
Yeah, I've been at KarpReilly for over 11 years now, and I've spent my whole career in and around the consumer retail space. Times are always changing, and consumer, almost by its nature, is cyclical. There are always big winners. It's a massive addressable market, and incumbents are often at risk of losing share to upstarts who can address the needs of the modern consumer in nimble and novel ways. The team here has been investing in early stage consumer for 3+ decades, and we view the world such that you have to adapt where you're investing and how you're investing to what the market dictates at any given time. And so there's an ever changing landscape, and we have to find where that risk reward is. I think today scale properties are back with a bit of a vengeance, and certainly more prevalent than they've been over the past 5-10 years, feeling a bit more like it did in the early 2010s. And so we have to be a lot more cognizant of financing risk. We still love investing in early stage consumer, across our broad definition of consumer, and direct to consumer, and CPG, and four-wall retail, which has been a long running pillar of ours. But in today's environment, when the lenders are not as flexible, and capital is not as free flowing as it was back in 2020, 2021, and similarly other early stage investors are being significantly more selective, you have to be willing to underwrite all of the capital needs that a brand might need until it can get to profitability. And so that's some additional risk that you're inherently underwriting. So while there's still a ton of reward and upside, and we still love the upside of the early stage investing that we do, those risks are elevated. And at the same time, we've seen a lot of investors leave the broadly defined early stage consumer space. And so we're finding, a better dynamic and more reasonable valuation expectations, more reasonable leverage expectations for, some of those, minority or majority recap deals. So we've been really excited to, slide back to, the kind of investing that we were doing 5 or 10 years ago. And so we'll still keep doing growth investing, but always adapting to what the current environment dictates.
I think maybe it was 6 or 9 months ago that when we chatted around staging and sizing, maybe you can just refresh the audience on and refresh me on where does KarpReilly like to play in the back end of 2025? How early? How much of it is kind of growth equity?
Yeah, so it varies a little bit based on the sector, but as a general rule of thumb, we talk about our sweet spot as brands that have 20 to 100 or so million of revenue. We're looking for businesses that are either profitable, couple $1 million of EBITDA, or have a very tangible path to profitability on the horizon. We will write checks as large as 50 plus million, but our sweet spot is right around the $20 million level.
If a business is doing a couple of million in profit and off scale, how do they think about kind of that capital outlay?
Yeah, so it depends on the circumstance, right? Sometimes, there are founders or early investors that are, looking for some liquidity. Other times, it's looking to take what's working and really pour gas on the fire. When we, the type of investing that we do at KarpReilly is not we're not providing capital in order to discover whether the business model will work. We're looking for good business models that we can really help take to the next level, both with the capital to help unlock those growth opportunities and our experience and ability to bring more resources around the table to ensure that a company avoids the big mistakes along that journey.
And like you said earlier, I guess more realistic valuation expectations are helpful in this growth equity stage, that whether it's a bootstrap business, but especially I imagine if you do have an earlier stage institutional financing partner that's marking up something on a revenue basis that funded it to the point that is in your sweet spot, with valuation expectations now coming back to earth, you guys can engage appropriately rather than having this mismatch between kind of, call it early stage and even mid-market.
Yeah, look, there was a lot of deal paralysis over the past couple of years because folks and human psychology, we're all guilty of it, anchored to historical valuations and the expectation that things will return to those levels in due course. And right now we're in a situation where the economy feels a little bit fragile, and great businesses will persist through any environment. But there's the bar has been raised across the board, and the most important thing when you're a growing consumer company is to make sure that you have the resources to sustain that growth and to capitalize on the opportunities in front of you. And it's hard to realize that there is a cost to not properly capitalizing your business, but I've heard it called the hand to mouth tax, and it's very real. And so we are always looking for opportunities where, again, you can that capital has sort of tangible unlocks and tangible ROI for a growing company.
D2C founders, are you bleeding cash before your customers ever see your products? You spend months shipping items, your inventory sits idle, and your margins evaporate in logistics. What if you could slash your lead times and reclaim your cash flow? Meet Portless, the next-gen direct fulfillment platform built for high-growth e-commerce. They don't just store products, they ship directly from China and Vietnam to your customer's front door with a fully local delivery experience, skipping ports, cuttling handling, and making your inventory available for sale in days, not months. Portless offers up to 90% lower inventory lead times by removing middlemen and optimizing routes. A dramatic acceleration of cash flow because inventory is back on sale within 48 hours of manufacturing, reduced inventory risk because there's no need to overproject demand, and true global reach because you ship to 55 countries using domestic last mile carriers. Now here's the promise. Switch to Portless and you're no longer paying for inefficiencies. Go to portless.com, get a free quote, and see how you can reinvent your supply chain. Don't let logistics throttle your brand's growth. Try Portless. Real speed, real savings, real scale. Are there one or two brands, Drew, that the audience might have heard of that you can walk us through? Maybe the stage that KarpReilly got involved, and then especially kind of, are there any attributes that you think made them really successful?
Yeah. Look, we've been really fortunate to back some incredible founders across CPG, apparel, home goods, beauty, personal care, restaurants and general, four-wall retail. Lots of great brands on the list, right? We pride ourselves on supporting brands and taking a long-term focus on truly building a brand. So they've been part of stories, like Made In and Stio and Hungry Root in CPG world. We were investors in or early investors in Spindrift and Kavita. The restaurant side, Salt and Straw, ice cream, which is always a fan favorite, Cooper's Hawk Winery, restaurants. Maybe a good example, an investment we made in the direct-to-consumer space was a beauty subscription box company called Boxycharm. We invested when the business had a couple $1 million of EBITDA. It was ultimately a two-step transaction where we made a smaller investment up front. Founder took a little bit of liquidity, and then we had a second step of that transaction where we increased our ownership position. Founder remained involved. He was an absolute machine, real visionary founder who was scrappy and extremely in tune with what the consumer wanted. So the business, was full size, products, and was able to provide a lot more value to the consumer. And so, we were really, it was just a great outcome for everyone where, we were able to get that founder, that second bite of the apple when we ultimately exited the business together.
Yeah, no, that's amazing. And other than kind of ability to scale, or maybe we'll start there. Like, is it a TAM exercise? Like, how do you, what are the attributes? How do you kind of evaluate a business that's doing early stage kind of EBIT and that it's, got the space to go all the way?
Yeah. I find TAM really hard to define. I find predicting the future even harder. So I'm really a nuts and bolts guy, and most of us here at KarpReilly, it's how we operate. Where our upbringing, if you will, is from brick and mortar retail, right? Back in the late 80s and early 90s, investing in mall-based retailers. Of course, that's not where modern brands are being built, but fundamentally, it arms you with a mental model and thinking about the core building block unit economics of a business. And so for us, we're looking for businesses where there are bright spots and green shoots, but again, where the unit economics are working. So in direct to consumer, everyone thinks about your LTV to CAC. Of course, that's the fundamental scaling, economics of a direct to consumer business, and that's super important to us. But breaking down, making sure that you have margins, you have a moat, you have a reason to be. Your customers, are community is maybe a little bit overblown as a phrase, but I like to ask the question: if I got a bunch of your customers in a room together, do I know what they would talk about? And I want the answer to be yes, because to me that means you have a brand and you have a, a customer base that is identifiable that has core characteristics. Now there are exceptions to every rule, but I think a lot about moats, and I think it's really important as an early stage business to think about what it is that's going to define me and differentiate me from my peers. Oftentimes in what we do, that is brand, but making sure that your brand is unique, that you do have a real reason to be, and leaning into that. And certainly over time, there's a delicate balance on staying true to your core customer, your identity, while on the margin, making sure that you are including a larger consumer base to really unlock that TAM and be able to translate that brand in different regions to different age brackets, et cetera, as might be dictated by your specifics. But it's really important to us to identify what is sticky about your customer and what is protectable about what you're building.
And around that brand mode, are you happy for that to be kind of the softer founder voice, or do you need it to be kind of something harder around IP, trademarks, size of social following? Like, kind of how hard and soft do you need that brand moat to be?
Yeah, I don't ascribe a ton of value to IP in consumer land, and frankly, we're not so sophisticated that we have a faith in our own ability to assess defensibility of IP. Um, Founders can absolutely be moats in and of themselves. I mean, some of the founders I've had the pleasure of working with are machines and are supermen and women, and so that absolutely both from a brand and understanding of the customer, and also just from execution. At the early stage, execution can be maybe not a long term defensible mode if it's founder driven, but the old saying that is it's sort of 10% strategy and 90% execution. It absolutely is the truth in my experience. And I would just add that over time, um, ensuring that a founder's energy, brand, identity, and understanding of the consumer, making sure that can scale as an organization grows from, you know, tens of people to hundreds of people, over, years, is critically important. And that is really difficult when a founder cannot interact with every single one of their, employees and coworkers on a daily or weekly basis. And so making sure that the organization has, um, the processes in place to make sure that everyone buys in and can understand what the founder's vision is and can execute against it.
In pre-recording, we were talking about some of the attributes of the K-shaped economy and kind of how you were thinking about that internally regarding capital deployment. Are there any consumer categories that you're more excited about right now than others?
Yeah, look, we remain really excited about what we're seeing in consumer land. Was talking about how it's ever changing, and right now one of the undeniable characteristics, however you feel about it, is that there's a K-shaped recovery, and what we're seeing with some of our more premium brands, you know, call it an accidental experiment in light of some of the tariff um, volatility. Some of our brands were forced to take price, and fortunately saw that there, wasn't a lot of pushback and wasn't a lot of demand loss on some of those price increases. And, certainly there are price increases happening, across the spectrum right now, which provides a little bit of air cover. But, what we're seeing in restaurant land, in direct to consumer land, where predominantly the customer base and most of our portfolio are higher earners, and they've been relatively less affected in what's been a tougher consumer environment. We have the fortune of investing across the consumer spectrum and can learn from the different uh, sectors that we invest in. So we're certainly seeing the subsectors that are more affected, and where the lower income consumer is having a hard time, and so we have to be really mindful of you know long term trends and ensuring that we're not falling victim to the unfortunate reality of our economy.
Are there a couple of trends running, GLP-1, protein, that you're particularly interested in?
Yeah, we've been paying attention to the trends in protein for a while. We th- it does not strike us as a fad. It's been a decade long trend around pushing more protein in diets. We have investments in a few brands that are riding that wave. Wild Protein Chips, Remedy Organics, Koya, and so we're absolutely seeing the strength of that, and certainly within the Ozempic, Wegovy, GLP-1 community, where they're one of the downsides is with less caloric intake, folks are losing muscle mass, and physicians are really pushing an increased protein consumption on those consumers. So whereas categories like salty snacks are seeing a lot of headwinds from GLP-1 usage, and if you read earnings releases, there's a whole lot of talk about the long-term potential headwinds, particularly if the GLP-1s can move from injectables to ingestibles, pills. And so, a company like Wild really is a bright spot within the salty snack category because it is an indulgence, but it's a healthy indulgence where it has, all natural ingredients and, protein to meet the, demands of both health and wellness focused customers and that growing portion of the population on GLP-1s.
AI. Everyone's talking about it, and you're worried you're getting left behind. Meet RichPanel, an AI-first customer support platform that's built for one thing: making support faster, smarter, and cheaper for e-commerce brands. Something you can actually feel smarter about using. RichPanel combines a unified inbox across email, chat, and socials, a customizable self-service portal that customers actually use, and Sidekick AI, powered by GPT-4, which learns from your past tickets to suggest on-brand replies. Does it actually work? Well, with RichPanel's guarantee, you get guaranteed 30% cost savings when you switch from Zendesk or Gorgeous, 30% automation to reduce your ticket volume, and a no-risk guarantee that if RichPanel doesn't deliver those results in 60 days, you get a full refund. That's why top brands like Ridge Wallet, Jones Road Beauty, and Pella Cases are already using RichPanel to save hundreds of thousands in support costs. Time to start letting AI work for you. Head to richpanel.com and start your free trial today. Real savings, real automation, real AI that actually works. I think one of the criticisms of the last maybe 10 years of consumer is that there was a lack of product innovation, or at least there were too many Me Too products, that there are, so many RTD protein beverages now. There are so many millennial cookware brands, etc. And is that something that you're pushing your portfolio companies on harder, of like, hey, what was innovative 3 years ago is now competitive? What's the next, how do we find the frontier?
Personally, I find myself pushing folks a little bit more to focus. It's really easy. It's a really easy trap to fall into when you have a great brand and when you have success with your core product line, to think about what else should I be doing, right? And I think it's Steve Jobs who talks about focus is saying no to a lot of good opportunities, and that's a really hard thing for all of us. We get really excited. Founders have brilliant ideas, infectious energy, can be convince you of anything, and we always have to balance crossing that frontier, expanding that brand, with just continuing to execute and focus. And so, when things are going well, trying to avoid that distraction is as important as continuing to to find the new frontier. But without a doubt, innovation is almost inherently the lifeblood of startups that are taking share. So we're always thinking about and looking for those. I also think I was just talking about this earlier today. As far as both for new investments and for the portfolio, I feel like it's getting easier. 4 or 5 years ago, when capital was flowing freely, there was a lot of competition and a lot of innovation out there. It feels today that our brands that have scaled a bit and have brand equity are able to push the envelope in a way that maybe there would have been a lot more fast followers a few years ago, even for companies that are doing really hard things. And today, there certainly seems like a little bit more leeway, and it's feels a little bit easier to identify those that are genuinely building something differentiated.
On distribution for your consumer products businesses, whether starting online or natively in retail, given the kind of consumer focus, is that something that you spend time with them on leveraging your network, best practices, or is everyone still kind of relatively novel and runs independently?
Definitely. We pride ourselves on sharing best practices across the portfolio, leveraging our decades of experience to help folks, while at the same time acknowledging that there's no playbook. And I think anyone who comes to you talking about a playbook, um, my antenna would be up, because what worked for another brand 5 years ago is very different than what's going to work for you today. Your brand is different, the environment is different, the competitive landscape is different, and so I find it's way more helpful to learn from the mistakes of others. And I think my job, as much as anything, when I'm supporting the portfolio, is ensuring that the companies I work with, the founders that I talk to on a daily basis, can avoid the mistakes that I've already been a part of. And I joke that they'll make their own mistakes, and hopefully they're smaller than the mistakes that we've made in the past. But we invest in great entrepreneurs and great brands. Um, Success is driven more by fighting the good fight and continuing to avoid hardship than it is by needing to capture explosive growth.
Speaking of mistakes or missteps, for brands that are scaling 10 to 50 million or jumping from 50 to 100, are there organizational or operational kind of missteps that you've seen now or repeatedly that, you would really encourage people to avoid?
Yeah, I think the biggest thing for me that I'm often thinking about when talking to founders is I'm constantly encouraging folks to build a business for you, not for an investor. Investors' desires and focuses seem to change on a whim, and of course you have to be mindful of that. But for us, we've found that a lot of the best entrepreneurs are ones that are building, what we call early stage businesses, not startups, and make healthy decisions along the way, instead of making decisions based on what you think an investor or acquirer wants to see. So a little bit of, field of dreams. If you build it, they will come. Some business models do necessitate a bunch of capital, uh, but within consumer, our view is more so that an investment should serve as enhancing what's already working, as opposed to like we were talking about before, discovering whether the model can work at scale. There are different investors that take different approaches. There's some venture investors, certainly within software, when you look at things that have massive terminal margins, where that works quite well. We have a different approach, and the many of our greatest success stories are fit that mold exactly.
It sounds like a great model. Invest in something that already has product market fit, that the market clearly wants, with good margin profile and retention profile, that already has the momentum. Encourage them to focus, try to help them avoid the mistakes of the past. And yeah, it seems like it's a great recipe for success.
Thanks, man. Look, it's not without its turbulence, right? It like we talked about, there's constant trials and tribulations within early stage consumer, and lots of growing pains along the way, even for our greatest success stories. So, the success is not a straight line, and we've certainly found that to be the case.
For the audience that's wondering if there's a tactic or a channel or maybe a new piece of technology that's working especially well for the portfolio, is there anything you can share on that front?
Yeah, there are a few things I think about. Within the marketing sphere, we've seen that building genuine connections with influencers and celebrities even can be really valuable. The in today's era of TikTok and Instagram, that remains as powerful as ever, and frankly, where acquisition costs through paid channels is a- less efficient than it's been in the past. You have to get creative, and you have to find that brand proof. There's a lot of imitators out there. There are a lot of international products that don't have your brand, but as much as you and all your employees and all your friends and all your existing customers know your brand, to a new customer, they see you and they see a knockoff, and they don't know that your quality is better, that you have real people that are willing to stand behind and have real customer service. And so that influencer network can really be a point of validation. So that still works. You can't half-ass it. You have to really build those relationships. You can't outsource it. And similarly, you really have to build some great content, both to attract those influencers and to engage with consumers. And it's not necessarily branded content. It's just great content, right? Everyone knows the stories where there's great founder content, behind the scenes content, just entertainment. That still works. And the problem with not the problem, but the risk with both of those is they're a slow burn. You don't build an influencer network and tomorrow overnight, have attributable revenue for it. This is the hard stuff that folks have to do, and sometimes they're not always free. So you have to build those things and incorporate them to sort of your core and your identity. But we're seeing a lot of great success stories when folks can really hone that skill set and build those networks up. The other thing that is on everyone's mind right now is everything AI related. Half dozen new AI enabled, maybe AI created software tools popping up on my radar every week. That's where we definitely are leveraging. I see it as part of my responsibility to identify those tools, be in constant communication with the portfolio, gather information from the portfolio to see what's working, what's not working, what do you hope works in the future. It's definitely imperfect today, but it's already helping teams get more efficient. It's a little bit of a needle in the haystack right now, but there are tons of examples of real progress being made on various fronts, from drafting content or drafting copy or creating content, imagery, Photoshop type skills, customer service. It's starting to chip away at some of those low-hanging fruit tasks. Certainly lots of busy work, research. One area, saving on legal fees and just making some legal processes more efficient, letting some of these LLMs be your drafting partner. Definitely still get legal advice and the thumbs up from an actual attorney, but that reduces 10 hours of legal work to an hour or two of legal oversight. Continue to experiment is what I'm seeing, and what everyone is seeing is that these tools are getting better quickly. And even though right now it's a little bit, the 80-20 rule still needs oversight. If that's at some point, that will no longer be the case. Whether that's 6 months or 6 years, I don't know. But it's like anything. You want to make sure you're not late to these fronts. And like anyone who can remember back to early TikTok days, early Instagram days, those that are early and tapping these new tools or channels can really go through.
The following message is brought to you by Fulfill, a sponsor of the podcast. Every dollar sitting in slow-moving inventory is a dollar you can't use to scale. Most e-commerce brands have 30 to 40% of their working capital tied up in the wrong SKUs, and they don't even realize it. Fulfill.io changes that. It's an ARP built for Shopify brands that want full visibility into their inventory and cash flow. With Fulfill, you can see days of inventory on hand by SKU, forecast reorders based on actual sell-through, automate purchase orders, and thanks to native 3PL integrations, you'll know exactly what's sitting in your warehouse, not just what Shopify thinks you have. This is real-time inventory intelligence that helps you stop overstocking losers and start compounding cash in the right places. Brands like Grunz, Monos, Mujiri, and Caraway use Fulfill to free up hundreds of thousands in working capital. Don't let your inventory decisions kill your margins. Get clarity, get control at Fulfill.io. I liked an analogy that I heard recently of it's like early search 20 plus years ago for people that were a year ahead of learning how to use search. Their kind of knowledge, them as a knowledge worker, kind of expanded dramatically versus someone that was, maybe a little bit more of a boomer and a year or two later. But even from my own work, I found it to be incredibly productive. And like you said, just trying to push myself to experiment.
I've
And
used the same analogy, Fan, where I've said, I remember when I asked my mom to Google something for the first time, and she Googled something like, food store near me. I said, you can't do that. This was before it had all the geolocation. And I just always remember this story. I need to make sure that I'm experimenting with things so that I am, literate on these tools and making sure that the world doesn't pass me by. And certainly, lucky to have a lot more, uh, uh, capable folks at each of our portfolio companies who are really on the forefront of testing these tools and getting more out of them. But need to make sure that we keep up.
yeah, no, absolutely. That's always the fear that I'm trying to hedge against in my work of not becoming a boomer. Yeah, Drew, as we head towards a wrap, what's your biggest piece of advice for founders heading into 2026?
Yeah, look, I think keep fighting the good fight, right? There are ebbs and flows, within capital markets. There's reason for optimism. The IPO markets seem to be open. Big deals and small deals alike are getting done. There seems to be some stability, and clarity is as much what's needed for financings and deals to get done as much as positivity. And so I think there are every day. I'm learning about incredible new businesses and meeting incredible new founders. So I am never cease to be amazed by all of the energy and passion out there. So while it's not capital's not free flowing, and being a startup founder is probably as hard as it's ever been. There are still amazing success stories and really incredible companies being built in every environment. And when you look back over time, it's the best businesses are often built in the toughest environment because there are more constraints. And if you can build a great business in this environment without a ton of capital, that you have that product market fit. That you have a business that has a reason to be. And so again, even if it never lines up for an investor, building something that you're proud of and building a business that can stand on its own 2 feet is something to be proud of. I think capital raising is often glorified as the goal. It shouldn't be. It's sort of a step towards an accelerant for some businesses where it makes sense. But entrepreneurship in and of itself should be celebrated, not just entrepreneurship that raises private capital. So as much as we love to be part of the ecosystem, I also love meeting founders that don't have any need for growth capital.
Yeah, just to kind of end on that positive note, I actually feel like in the last 12 to 18 months, we've come across more founders that have built incredibly scaled and incredibly profitable businesses over the last, probably since 21. That we've seen more $50 to $100 million revenue businesses built in the last 3 to 4 years. And maybe it is a combination of the top half of the K-shaped economy that consumers are willing to pay premiums for stuff that they really like. Maybe it's that these founders have gone through a challenging time, so are building businesses with better margins, being more efficient. Maybe it's some of Meta's AI investments connecting brands with specific avatars if there is efficiency to be gained. But yeah, like you said, still, really incredible when you come across these brands that are crushing. And yeah, lots of reasons.
Look, necessity is the mother of invention. A different era calls for a different way of growing businesses, and always the potential for virality and virtuous cycles exists in every business, and certainly in the consumer space. So that's why we're not going anywhere, right? We will always be investors in early stage consumer because those breakout brands and that potential exist through every market. And frankly, those that can do it in a capital efficient manner, that's always been a focus of ours. So again, like I was saying before, I think in a way, it's my job is getting a little bit easier. Where a brand that can do that without any support, that's a durable, well built business, not one that the is likely to see that cliff.
Yeah. Drew, is there anything you're seeking from listeners, brands you want to meet, operators, collaborators?
Yeah. Look, we love to collaborate with anyone who's passionate about consumer and retail as we are. And, ultimately high quality deal flow is the lifeblood of our business as investors. So we're happy to meet with, any growing consumer retail business north of, call it $10 million top line, whether you're looking for capital imminently or looking for, someone to shoot the shit with who might, throw some unsolicited advice your way. I'm always happy to meet new folks. It's really, what energizes me. I always joke that I don't have the guts to be a founder, but I'm constantly inspired by them, and that's what keeps me going every day.
That's amazing. Drew, thanks so much for coming on and look forward to next time.
Yeah, really appreciate it. Thank you so much for having me.